If you work overtime in 2026, there is a brand new tax break that could save you thousands, but only if you understand one detail that almost everyone is getting wrong. And if you miss it, you will either underclaim what you deserve or you will claim it wrong and invite a nasty letter later. Here is the promise. By the end of this video, you will know exactly what qualified overtime means, how to calculate the deductible portion, who gets phased out, and the 3 mistakes that kill this deduction for most people. Now, let me be clear up front. The phrase "no tax on overtime" is catchy, but it is not literally true for most people. Overtime is still taxable. Payroll taxes still apply, and what you actually get is a federal income tax deduction with strict rules on what counts. If you stay with me, I will show you the simple math so you can estimate your savings in under 2 minutes. Before we get deeper into how federal tax brackets affect your refund or liability this year, let's talk about something every business owner dreads but cannot ignore: properly filing your tax forms. If you're running 1099 contractors, issuing W-2 South, or handling payroll forms, one tiny mistake, one incorrect TIN, one missed deadline can cost you penalties, headaches, and hours of buried paperwork. That's exactly why you don't want to be fumbling around with outdated tax software or manual spreadsheets. When it's time to file, you need an IRS-authorized filing platform that's fast, accurate, and compliant with all federal and state requirements. That's where Tax 1099 comes in. Tax 1099 is an award-winning IRS-authorized e-file platform that lets you quickly submit all your 1099s, W-2 South, 94X forms, SCF forms, and more without the tax season stress. The guided workflow helps you create, validate, and submit forms in minutes. Assisted checks flag issues before you hit submit. Prices start as low as just a few dollars per form, and it integrates with QuickBooks, Excel, Xero, and other accounting tools you already use. If you want to make this tax season as painless and error-free as possible, especially with these 2026 brackets and standard deduction changes, use the link in the description to get started with Tax 1099. It's the easiest way to file your IRS forms on time without the usual stress. First, what is happening in 2026 and why you should care right now? The overtime deduction exists for tax years 2025 through 2028. And that matters because 2026 is the first year many payroll systems are expected to clearly separate and report qualified overtime compensation, which makes it easier to claim correctly. So 2026 is a big year for clarity, even though the deduction itself is already in effect. Translation: 2026 is where you can stop guessing and start claiming with confidence. If you understand what the IRS actually means by qualified overtime compensation. Now here's what kills me. People hear no tax on overtime and they think my whole overtime paycheck is tax-free. No, the rule is narrower and the IRS wording is specific for a reason. Qualified overtime compensation is defined by the Fair Labor Standards Act. Let me translate that into normal human language. Under the Fair Labor Standards Act, most covered non-exempt workers get paid time and a half after 40 hours in a work week. Your time is your regular pay. That is your normal hourly rate, plus an overtime premium, that extra half. This deduction only targets that premium portion. The deduction is limited to the premium portion of pay, typically the half in time and a half. So, if you are paid $20 an hour and overtime is $30 an hour, you do not deduct 30, you deduct the extra 10. That is the entire game. That one sentence is the difference between a clean deduction and a messy audit magnet. Now, the next question you are already thinking is, how much can I deduct? The maximum deduction is $12,500 for single filers. Married filing jointly can be higher, but we are sticking to that core cap for singles because it is the number most people need. But wait, That cap does not mean you automatically get $12,500 off your taxes. It means you can reduce your taxable income by up to that amount if you have that much qualified overtime premium. A deduction reduces taxable income. A credit reduces your tax bill dollar for dollar. This is a deduction, so the real savings depends on your tax bracket. Here is a simple way to estimate your savings. Take the qualified overtime premium you earned during the year. Cap it at $12,500 if you are single, then multiply by your federal marginal tax rate. If your marginal rate is 22% and you claim a $5,000 deduction, that is roughly $1,100 in federal income tax savings. Not your whole paycheck, not magic, but real money. And yes, for some households, that is the difference between drowning and breathing. Now here is the crazy part. A lot of people will not see the benefit in their paycheck during 2026. They will see it at tax time. Why? Because overtime pay is still subject to withholding rules during the year. That means your employer may still withhold federal income tax like normal. Then when you file, you claim the deduction, and that can increase your refund or reduce what you owe. So, if you were expecting your take-home pay to instantly jump, that might not happen automatically. Now let us talk eligibility, because this is where people get wrecked. You need to be covered by the Fair Labor Standards Act overtime rules and not exempt. If you are a salaried exempt manager, you can work 60 hours a week and have zero qualified overtime because you did not receive FLSA overtime. And if your overtime exists only because of a company policy or a union contract, but it is not required under the FLSA, the deductible amount can get tricky. And if your overtime is mandated by state law, but not federal law, this is huge in places like California with daily overtime and double time rules. That extra pay might not count as qualified overtime compensation for this federal deduction. Most people miss that. They assume overtime is overtime. The IRS ties qualified overtime to FLSA required overtime, not state-only overtime. So here is the clean rule you should remember. If the overtime premium is required under federal law, it is in the conversation. If it is only required under state law, it may not be. If you are in a state with aggressive overtime rules, you need to know which bucket your overtime is in. Now, let us make this real with two quick case studies, because people learn with numbers. Case study 1, the most common. You make $25 an hour. You work 10 overtime hours every week for 50 weeks. Time and a half means your overtime rate is 37.50. The premium portion is 12.50 per hour. Multiply 12.50 times 500 overtime hours. That is 6,250 of qualified overtime premium. If you are in the 22% bracket, rough tax savings is about $1,375. That is not life-changing, but it is meaningful, and it is yours if you claim it correctly. Case study 2, where people mess up. You make $30 an hour, but your employer pays double time for overtime, $60 an hour, because of a policy or state rule. A lot of people think, great, I deduct 30 per overtime hour. No. Under the qualified overtime concept, you are still generally anchored to the time and a half premium required by the FLSA. That means the deductible premium is still based on the extra half, not the extra full hour of pay. In other words, do not confuse high overtime pay with deductible overtime. So what should you do right now to not lose this benefit in 2026? Number 1, start tracking your overtime premium. I do not care if payroll reports it cleanly. Keep your own record. Save pay stubs. Screenshot year-to-date overtime hours. You need documentation. The easiest way is to keep a simple spreadsheet. Regular rate, overtime hours, and the premium portion. Number 2, look for the separate reporting. Employers and payers have information reporting requirements around qualified overtime compensation. And the IRS has already said there was transition relief early on, but the direction of travel is obvious. more explicit reporting, less ambiguity. If your documents show a separate line item for qualified overtime compensation, that is what your tax preparer will want. Number 3, watch the income phase out. This part is the silent killer for high earners. The deduction phases out for taxpayers with modified adjusted gross income over $150,000 for single filers and over $300,000 for joint filers. So, if you are grinding overtime and your household income is rising, you might be expecting a benefit that gets partially reduced. This is why planning matters. Now, here is what most people do. They ignore it all year. They file taxes. They realize they could have saved money, and then they scramble to reconstruct overtime from a pile of pay stubs in April. Here is what you should do instead. Treat it like a benefit you earned. Document it monthly. And if you are close to that $150,000 line, talk to a tax pro about timing, retirement contributions, and other moves that can keep your magi lower. That is how you turn this from a headline into real cash. And before someone says, "I do not itemize, so this does not help me," not true. The IRS describes this as a deduction available to both itemizing and non-itemizing taxpayers. So even if you take the standard deduction, this can still stack on top as an additional deduction. That is a big deal. Now, let us hit the 3 mistakes that get people in trouble. Mistake 1. Deducting the entire overtime rate. Again, you do not deduct the whole 30. You deduct the extra 10. The deduction is limited to the premium portion of pay, typically the half in time and a half. Mistake 2. Assuming state overtime automatically qualifies. If your state has daily overtime, double time, or special rules, that extra pay might not be qualified overtime compensation for this federal deduction, because the law ties eligibility to federal overtime required under the FLSA. Mistake 3. Thinking this eliminates payroll taxes. It does not. Social Security and Medicare still apply. Withholding still applies. What you are getting is a federal income tax deduction when you file. Now, let me answer the 2 questions I know are coming. Question 1. Should you change your W-4 in 2026 to withhold less? You can, but be careful. If you under-withhold and the deduction phases out because your income rises, you can end up owing. So do not guess. Run a projection mid-year. If you do not know how, your tax preparer can do a simple estimate in minutes. Question 2. What if you are a business owner paying yourself overtime? Most owners are not paying themselves W-2 overtime in a way that fits the FLSA framework, especially if you are an S-Corp owner-employee or you are taking draws. This deduction is designed for people receiving qualified overtime compensation reported on W-2 or similar statements. So do not assume it applies to owner compensation the same way. If you are both an owner and an employee, you need personalized advice. Let me give you a tactical checklist for 2026 so you can execute. Step 1. Confirm you are non-exempt and covered by FLSA overtime rules. If you do not know, ask HR, ask payroll, or check your classification. If you are misclassified, that is a separate issue, but for tax purposes, classification matters for whether you are receiving qualified overtime. Step 2. Identify your regular rate and your overtime rate. If you are hourly and it is time and a half, the premium is half of your regular rate. If your pay is more complex, like bonuses or shift differentials, your regular rate can be more complicated, so do not assume. Step 3. Calculate the premium portion monthly. Regular rate times 0.5 times overtime hours. That is your estimated qualified overtime compensation for deduction purposes. Keep that number. Step 4. Watch your magi. If you are hovering near the phase-out thresholds, plan ahead. A small move like increasing retirement contributions can change whether you get the full benefit or not. Step 5. When you file, make sure your tax preparer knows you have qualified overtime compensation and that it is captured properly. The IRS has introduced new mechanisms for these additional deductions, and the operational point is simple. Do not assume your preparer will catch it if you do not tell them. You need to say it out loud. Engagement trigger number 2. Comment below with your state and your overtime situation. Are you weekly overtime only? Or do you get daily overtime or double time? I want to see how many of you are in states where the federal versus state rule difference could matter. Now let us close with the big picture, because you need to understand what this is really for. This policy is basically a reward for labor, specifically for people putting in extra hours under the federal overtime system. If you do it right, you keep more of what you already earned. If you do it wrong, you either leave money on the table or you create a compliance headache. So here is your action step today. Open your last pay stub, find your overtime hours, find your overtime rate, calculate the premium portion, and write that number down. Do it once, and you will understand the entire deduction forever. And do not wait until tax season, because when everyone else is scrambling, you will already have the number. That is how you win. If this helped you, subscribe, because I'm going to keep covering the real tax rules, not the headline version, and in the next video, I will break down how the new reporting changes can impact your refund timing, and what to do if your employer does not clearly separate your qualified overtime compensation. Drop your questions in the comments. I read them, and I will see you in the next one.